Hello, Marc from ADM Investor Services International. With some thoughts this week on the fall in yields that we've had, the tightening of spreads, and what was exactly the driver behind this. So I'm going to start off with what appeared to be the trigger on Tuesday when the US returned to markets, which was the ISM Services Index. To be sure, it certainly missed forecasts, but the fact of the matter is when one looks at this first chart of the ISM Services Headline Index, it's at 60.1. It's still a few ticks away from where it was last month, which was a record high. That's the total sum on that chart of all the data we've ever had on this. And it remains anything well above anything that we saw for most of the period leading up to the pandemic. So what sort of reaction did it prompt? Well, next chart is the US 10-year Treasury yield. And as one can see, we've trailed all the way down to 134, 135. We've broken a long-term support line of the up move that we saw from about the middle of last year in US Treasury yields. It would appear that markets are starting to doubt whether the Fed will need to actually push back or taper, and is basically telling us that they don't believe in the inflation problem either. I think it's instructive in that part to compare this with what US TIPS yield, i.e. real yields, have been doing. And as one can see, there's been basically a very similar move. This is the third chart of the day. TIPS yield is down basically into the middle of the range towards the bottom of it, and basically is moving in tandem. That also means that break-even inflation rates aren't going anywhere. They're not going up, they're not going down. So this doesn't really have anything to do with the inflation outlook. And one could well probably extrapolate from that. That's probably not got a lot to do with growth at all. So where is the elephant in this particular room? I think the fourth chart is quite instructive. This is a chart of the Fed's reverse repo, overnight repo operations in total volume terms. It had, as we know, I've shown this chart on a number of occasions, been climbing for quite some time, and it is basically testament to a collateral shortage. Now, the most important thing that we have effectively established on the back of this is it wasn't just anything to do with quarter end, because basically we've seen a spike at quarter end up to the 992 billion level, but we're still sticking in there around 772 billion. That basically tells us there's actually a very chronic collateral shortage. And I think the other factor that people need to take into account is we have a very unusual 2-week period. It's an unusual 2-week period because there's been no coupon supply. Normally you get coupon supply on alternative weeks or practically every week. This is one of the few times when you don't, thanks largely to when the Independence Day holiday fell. And it really, again, attests to the fact that the Fed's QE program carries on every week in exactly the same pace. And when you don't get any new Treasury supply, so the collateral shortage just becomes that much more acute. So how does this play out internationally? Because I think that's obviously something which is always important in terms of currency influences. The three charts I'm going to show are the comparisons between US 10-year and German, Japanese, and Chinese 10 years. As one can see, the German-US 10-year spread is basically tightening to its lowest levels that we've seen since the beginning of the year, well, certainly the early part of the year. And yet the euro is, well, not necessarily on its knees, but certainly within the weaker point of its range, which is an interesting contrast when one looks at the US-Japanese 10-year spread, which basically means that this is basically making US Treasuries less attractive. And that's towards, again, towards the low of its recent range, with the yen actually strengthening, unsurprisingly. And again, with my last chart, one can see that also on the US-China 10-year spread. And having traded sideways after the Chinese basically suggested that they didn't really want to see a lot more strengthening, we have seen a little bit of an uptick in the CNY and CNH. So I don't think we really need to ascribe much of the Treasury move really to growth and inflation outlooks, but rather to the dynamics and the structural forces in place in the US Treasury market. Those are the thoughts for this week.